Hi everybody, and welcome back to video number 2. When we left off, we had just finished going through the financial statements. So here's a little concept check. Let's see what you would answer here. Which of the following accounts would appear in a company's income statement? And if you answered rent expense, that would be correct because we have revenues less expenses, which gives us our net income or net loss on the income statement. Accounts payable are a liability on the balance sheet. Cash is an asset on the balance sheet, and dividends appears in the statement of stockholders' equity. Okay, which relationship is reflected on the balance sheet? And this is one you need to know. Okay, and it is answer Bravo. Assets equal liabilities plus stockholders' equity. Statement of cash flows are something we will do a little later in the course, but as you see from this slide, it's broken down into the three business activities: operating cash flows, investing cash flows, financing cash flows. And as I stated earlier, operating cash flows normally involve revenue and expense activities, our normal business activities. Investing activities, they're going to include generally the sale and purchase of long-term assets, like land and building and equipment. Whereas our financing activities, or we're going to borrow money from the bank, pay the bank loans back, generate some dividends, sell some stock, that kind of thing. All right, so what does that statement of cash flows look like? Here is the statement of cash flows for that Eagle Soccer Academy. We divide them into those three pieces: here, here, and here. Operating activities, we have cash in from customers, we have cash out for salaries and rent. So sometimes we call that cash disbursements or cash payments, and sometimes we call it cash receipts. So different terminology for the same thing. And so our net cash is the difference between cash in and cash out for these different activities. So here we've purchased some equipment here for investing activities, and here we've issued some common stock, borrowed some money from the bank, and paid some dividends. So what we do is we would have our net increase in cash. In this company, we started out with beginning cash of 0 because we started, as you recall, December 1st. And then we add the net increase in cash to the beginning cash, and we get the cash at the end of the period. And that's $6,900. I'm going to go back to show you that that's going to tie out here to the cash that we report on the balance sheet. All right, so let's do a little concept check. Take a second and look at this. The cash collected from a customer would be recorded as which type of activity from a customer? If you answered alpha, operating activities, you'd be correct. It's a normal revenue and expense transaction. Collecting cash from a customer represents revenue. Okay, this is especially an important slide, so I want to be sure you get this. We do these financial statements in a specific order. We do the income statement, then the statement of stockholders' equity, then the balance sheet, then the statement of cash flows. And we do that for the following reason. We need to have our net income here roll down into retained earnings here on the statement of retained statement of stockholders' equity under the column retained earnings. Then we subtract out our dividends and we get an ending balance. Now, that ending balance in total stockholders' equity, that rolls down into the balance sheet here. And now we can prepare our statement of cash flows. Won't go through that in too much depth here, but here we had cash flows from operating activities, investing activities, and financing activities. We had a net increase in cash of $6,900. We started with zero, so cash at the end of the period is going to be $6,900. So really important to understand those relationships. Okay. Key point. All transactions that affect revenue or expenses are reported in the income statement, and that ultimately affects the balance sheet through the balance in retained earnings. The key word here is ultimately, because we're going to do our income statement, and then at the end of the period, we're going to roll that balance into the retained earnings and zero out the income statement for the next period. We call that the closing entries, but a little early to get into that, but I just want you to see that word ultimately is really important here, because we're going to be populating the income statement during the period, usually a month, and then at the end of the month, that's when we'll zero out the income statement and roll its balance into the retained earnings. Okay. Other information reported to outsiders include the company's annual report. A couple of interesting pieces of this. One is the MD&A, Management Discussion and Analysis, and it's basically management's views on how the company did during that time. Very good reading from the standpoint of they know the most about what's going on with their company. But also sometimes we have information that does not result in a financial transaction, but is still important. And in that case, we have what's called a note disclosure. We write out exactly what we have done and the impact that that information provides. Okay. So, we're now going to describe the role that financial accounting plays in the decision-making process. Here, it's cute, this little diagram. It shows the economic activity, the judgments that are made, the shades of gray that we make, and then we provide useful information which has the consequences of good, or the potential for good, decisions. And that helps a prosperous society make good decisions with regard to how they invest money. So, the practice of accounting does involve judgment and critical thinking skills. No question about that. What makes it fun. All right, not terribly important here, but the relationship between stock price and the changes in net income over time. So the investment value of those stocks go up, of course, as we make money. And for those companies that don't, it goes down. All right, and now we get to financial accounting information. Here, we're going to look at what's referred to as generally accepted accounting principles. You'll hear that term a lot in this course. We call that GAAP, financial accounting. And GAAP is something that you're going to learn about in this course. And we want to make sure that we have some formal standards that we use to prepare our financial information. And that's what the generally accepted accounting principles are. Who makes these generally accepted accounting principles? Well, it's the Financial Accounting Standards Board. And that's a private board comprised of practitioners and educators and outside audit firm representatives. It is really a feather in your cap to be on this board. It is very prestigious, and they do a really great job. It's governed, however, by the Securities and Exchange Commission, which is a governmental board. And so that is the United States only, however, that GAAP applies to. The rest of the world uses the International Accounting Standards Board, IASB, for all other 200 plus countries. So we're the only one that uses generally accepted accounting principles. The rules of financial accounting are called these generally accepted accounting principles, and the Financial Accounting Standards Board is, as I said, an independent private body that has the primary responsibility for establishing generally accepted accounting principles, GAAP, in the United States. Okay, the importance of auditors. Trained individuals, CPAs, certified public accountants, that's what that license allows you to do. Render an opinion on basically two things. Are the financial statements prepared in accordance with generally accepted accounting principles and free of material misstatement, as well as assessing the level of internal controls, which we'll get to later in the chapter. But those two things. So the role of the auditors helps ensure that management has in fact complied with those generally accepted accounting principles. And they play a major role then in the decisions of the investors and creditors because it provides credibility to the financial statements. All right, here is an example of Dick's Sporting Goods. And Dick's Sporting Goods, as you see here, you can read this on your own, but here you can see it presents fairly in all material respects. That's what this outside auditor has concluded. And this is the letter. Once you go through this whole rigmarole of getting your annual outside audit done, this is what you get, a letter that says all is well. Okay, sound good? Okay, so therefore, the objectives of financial accounting. It provides useful information to investors and creditors in making their decisions. It helps predict future cash flows, and it tells about how economic resources, claims to resources, changes in resources occur. Okay, let's do the concept check. Auditors are independent parties that help. If you said, let you read it. If you said answer B and C are correct, you would be correct because auditors are hired as an independent party to express that professional opinion. All right, this is probably a good place for us to stop this video. And when we finish, we will start again with our last video, number 3. We'll see you in a few minutes.